Good afternoon, everyone. Good to see you again. Welcome to the webinar. My name is Jay Norris. As always, we need to point out that trading futures and Forex is a risky endeavor and not suitable for all investors. You definitely have to be prepared before you trade. You have to take your education, you have to take your experience very seriously, as we often say before we start a course. If you have bad habits in life, they'll tend to only become magnified in your trading. My name is Jay Norris. I spent over 20 years working on the floor of the Chicago Board of Trade when I was a young man. And I've written a couple of books on trading which were published by McGraw-Hill and serve as the textbooks for our courses at IBUniversity. The tactic we're going to show you today is highlighted on the book on the right, Mastering Trade Selection and Management. Hi, Boki, good to see you. I'm also a professor at IBUniversity, where I spent a considerable amount of time teaching and demonstrating the art of discretionary trading in live markets. The methods we teach include, the method we teach includes both mechanical and behavioral aspects. I think that's important. I think you need a mechanical framework to put everything in order vis-a-vis the price pattern, the direction, even the day-to-day fundamental events too. You want to get that as mechanized as you can, and then once you have that, you're able to apply the behavioral aspects to it, such as shifts in momentum, shifts in sentiment. Before I cover how we can help your trade selection, a few words on methodology. The first thing you will need if you expect to trade successfully is going to be a robust trading method which works in all environments. It took us over 4 years to put together a trading course that teaches an objective empirical method that you could use in all trading environments, meaning in up markets, down markets, sideways markets, regardless of shifting fundamental conditions, regardless of the markets even topping or bottoming, and we could show you a little bit about that today. If you're going to trade, you need a method for all seasons, and that method also needs to be simple, and that it needs to be easily explained. Whatever method you're using, or whomever is teaching you the method, needs to be able to explain what studies the method is based on and why the method works, and they need to be able to do that in as few sentences as possible. You know what? In a word, it comes down to it needs to be intuitive. You need to be able to sense relatively quickly that it's intuitive for you, if not immediately sense that it's intuitive for you. And it needs to be easily demonstrated that it works too. That's essential. For example, if I had to summarize the method we teach as quickly as I could, I would hit 3 points. I'd say we use pattern recognition to identify a market's growth pattern. When we say growth pattern, we mean is the market, it's either growing or contracting. A market is much like a plant in that it's either growing or it's contracting, really not a whole lot in between. Although in the markets you can go sideways, and I guess you'd see that as neither growing or contracting, but really overall a sideways market is just consolidating gains, right, or losses. So really there is only two directions the market can go in, either up or down, and that growth pattern is going to be able to pop out right at you pretty quickly. The second point would be we use the scales of that growth pattern on lower time frame charts to identify buy and sell zones in line with both the higher time frame patterns and the day-to-day news flow. That last part's important, the day-to-day news flow. If you want to know what the day-to-day news flow is, generally look at your last 2 weeks trade on a 4-hour chart, and that'll be a pretty good approximation of that too. There's nothing wrong with understanding what's going on in fundamental numbers. Also, I noticed today that you had another terrible manufacturing number in the U.S., but the market really shrugged it off, at least short term anyway. That's a little bit telling. It's telling me, hey, the market shook off the bad news, but yet there's still bad news out there. So we wouldn't expect too big of a recovery because you had bad news. But at the same time, it's important that we notice that the market did really pay no heed to it initially and actually tried to rally. So you want to notice things like that because that's how you'll notice when that day-to-day news flow shifts too. But the the day-to-day news flow is not even that all that. Well, it's important, no doubt about it. It creates momentum. I don't want to say it's not that important, but what's even more important would be that overall growth pattern. And that growth pattern is going to pop out at you on the chart. Basically, that's just, you know, the channel lines you're going to be seeing or how the market's reacting to retracements. Retracement would be the trading word, the key word there. So that would be number 2. And number 3, you need to have a fact-based trigger for our perspective anyway. We show you a fact-based trigger to enter and exit trades, and that trigger's it's really not going to change. You want it to be the same thing. You want your trigger to be constant. And we're going to show you how to use news and momentum to filter your trade selection, and we're going to try to show you that today. When I say use news and momentum to filter your trade selection, that's as easy as exit a trade before the news, get back in the trade after the news, after the market's shown you that despite the news, or perhaps because of the news, the market's hanging on to the trend it's in. So exit short-term trades ahead of the news always, especially if it's a red number on the calendar. And then if everything's all things being equal, you want to get back in. So you don't want to just trade right through news, that's for sure. So that's what we mean by the third point: use news and momentum to filter your trade selection. The big question is, and you know, the title of the webinar is titled Live Market Exercise. That's also something we do quite often. But to me, here's the question I want to ask: how can we help to improve your trade selection? Maybe the webinar would be better titled "How can we improving your trade selection?" Because that's why you want to be here, and that's why I would want to do this too. So I think this is quite an apropos question: improving your trade selection. So how can we help improve your trade selection? Well, first of all, we need to make sure that we keep you out of trouble. We teach you something that it's going to help you, not hinder you, because it is trading, and people can get an awful lot of trouble in a trading account. Well, one thing I learned in the 4 years it took to put together our courses, that the most important thing was knowing when direction is aligned with price pattern, because this determines when to enter a trade, when to exit a trade. Essentially, this is the trigger we use at IBUniversity. So know when direction is aligned with price pattern. Before we go any further, however, we need to break this down and define both price pattern and direction. And, the last couple of weeks we did this, we just showed you canned charts. I think today I'll show you the canned chart just so you get an idea how to identify direction. Then we can go to some of the markets today and see how they're aligned on our direction, because how the patterns are aligned, et cetera, because that's going to help us with trade selection. Analysis, by the way, is extremely important to us. You want to be a good analyst before you get to the trading aspect of it, and you want to understand the difference, because you don't want to trade until you're a good analyst. That's why it's so important to if you're starting any kind of new program, even if you're introducing a new wrinkle to an existing program that you're trying, you want to do that in a demo account first. So, hey, know when direction is aligned with price pattern. Here's a very simple demonstration of that. This is a daily chart of the euro. We've marked the isolated highs and the isolated lows on this chart. Pretty simple, and that's all it is, a matter of marking those isolated high and low points and identifying whether the market is exhibiting a bullish or a bearish pattern over a specified length of time. This goes back well over a year now, and there's no hiding it that you have a bear pattern, and you could see that by marking those isolated highs and lows and then just putting some big wide channel bands on there. You could see that, no doubt about it. It is a bearish pattern, pretty obviously a bearish pattern, and this was back at the end of March, and we know what price did. It actually came down towards here, so the pattern held bullish, and you had some good downside action. That's midway through March. Prices are quite a bit lower. So price pattern, a pretty obvious thing for us. And speaking of price pattern, let's go to a live chart now. Okay, did everyone make the switch? Can you guys see the live Australian dollar chart, the daily chart? Okay, great. Thank you, Phil. Look at the price pattern on this chart, and you've seen I've taken the liberty to draw these lines on here. Basically, I'm just marking the isolated highs and lows as the market goes up. And how would we have to categorize where the market's at right now? If I put a line right there, well, we'd have to say that the pattern here is still one that's bullish, right? We slap some channel lines on there, some old school channel lines on there. We'd have to say that looking at the Australian dollar right now, hey, that pattern is still bullish. This is a weekly chart, and you're going back several years. I guess we could call that a grand pattern. A little bit longer in the tooth than a primary pattern. Generally, primary pattern, you should be able to discern a primary pattern with about 1 year's worth of data on the chart. So, boy, this is about a grand pattern we're looking at right there. So, somewhat of a bullish-looking chart, this weekly Australian dollar chart. Right? I don't think anyone will dispute that. That's a good-looking pattern, good-looking bullish pattern to it, right? So, I just want to show you that. I'll show you what occurred here. Or let me take that line out. That's just one I put. But we're going to get back to that. Let's go back to the slideshow and continue with the definitions, and then we can go back to the live charts too. But I just wanted to show you that overall the Australian dollar has a pretty bullish overall longer-term pattern to it, right? Okay, hopefully we're back on the slideshow now. And that's that can price pattern chart that we show you. Here's another obvious pattern to it, right? This is your S&P 500. Definitely a bullish pattern to it, right? And we could see by the highs and lows that the U.S. stock market over the past few years, I guess you're getting into a grand pattern here. This is still the primary pattern is still up. Over a year is still up. You're getting into a grand pattern now. Primary pattern stretching itself out into a grand pattern. So the grand pattern here in the U.S. stock market is pretty bullish looking chart here. Now this chart's a couple months old, so it hasn't been updated. We don't have the foresight of seeing that correction that recently occurred there. So we'll go to a live chart in a bit, but I want to make a point here. It's so important that you recognize price pattern, or more specifically, those growth patterns within that overall price pattern, because they're scalable. Right? Hey, is everyone looking at? We're all back on the slide point. We're all looking at the PowerPoint that says price pattern, and you see the S&P 500 chart. Just want to check. Thank you, Philip. Okay, it's very important that you see the growth pattern and that they are scalable. If your eyes left here on the chart, this is what we mean. The smaller price moves are more often than not scaled replications of these larger price moves. So knowing when price direction has essentially shifted in line with that pattern is a critical point on the chart. And you can see we circled both those points where, in fact, price did change direction right there in line with the pattern. And then right there at the famous bottom in the market last summer when everyone thought the wheels were coming off the wagon, and it just proved to have been a heck of a buy opportunity. So knowing when price direction is shifted in line with that dominant pattern is critical. An even more simplified way to look at this is that we're, as traders, looking at this chart anyway, you'd be looking to buy dips in an uptrend. So you're looking to buy dips in an uptrend. And also, you want to focus on those patterns, too, the repetition on that chart. Let's go to the real-time chart again. And let me switch over. Okay, there, everyone should be looking at my screen here, and you should be looking at the U.S. stock market, right? And we'll point out that pattern that we're looking at. So you can still see you have a pretty bullish looking picture, right? Very good, thank you, Philip. Now you've noticed I've drawn some lines on the chart here, and hopefully you can see those in green there. It's kind of lime green. I don't think I'll need to choose a better color next time. They don't show up that well. Well, lime green color. You know what? I was talking about the scales. Well, I'll just tell you outright, the stock market has a bit of a history with 382 retracements. There's just something about that 382 number. The stock market likes that number. See this green line right there? What is that? That's a 382 retracement. You can see my 382 right there. Bam. Market bottom right on 382, especially long term. Not necessarily intraday, but long term, the stock market likes that 382 number. Here's another 382. Actually, the market bottom here when you go from the bottom of the move to the top of the move. Here, look at that beautiful double bottom on the 382 there. 382 in lime green there. I'll have to go with a darker color next time, but everyone sees where the market bottom. Stock market likes the 382. Let's see where we're at right now. Look at that. You're on a 382. I go down to a daily chart now. You can see a little more detail. Look at that. You're right on top of a 382. And why is that yellow line there? Well, that's a change of direction. We need to come back to that because we haven't covered that yet. Well, you would have covered it if you watched our last couple of webinars, but you could see you had a change of direction right on a 382. When you go down to lower time frame, you start to see that could be a significant event. Now, and we'll cover that. Let's go back to the slideshow and cover change of direction first for those of you who are new with us, and you'll start to see the significance of what we're pointing out overall. Why it's so important that you identify that spot on the chart where you had a change of direction in line with the pattern. Okay, that was the chart. Hopefully everyone's looking at an S&P chart now. It's price pattern slide. That's the old S&P chart. We just went to a live S&P chart. Now, what's so important about price pattern also that you recognize. Oh, I apologize. We need to move on. Obviously, we're here to show you that when you get that change of direction in line with the pattern. But also you want to recognize that the patterns you see on the chart, the growth patterns that you see, price moves overall are essentially, they're going to be scalable. More times than not, they're going to be scalable. It's really important that you understand scalability on a basic level because if you don't, you're going to start to overlook basic patterns, especially if you're focusing on technical indicators or crowding the chart with other overlays, or if you're relying on those indicators on the bottom of the chart. I see so many times guy will have three indicators and moving averages on the chart and all that stuff. From my perspective, it tends to take you away from price and cause a little bit of confusion. So it's important that you do recognize these higher time frame patterns because there it is. You can see it because those higher time frame patterns so oftentimes are replicated on the lower time frames. Eyes right on the chart there, and you can see, and then eyes all the way on the right. That little formation, you could see the market it's replicating itself on the higher time frame patterns being replicated on the lower time frames. And it works both ways. Lower time frame patterns will get replicated on the higher time frames too. So it's important that you start to notice that. Just these simple observations of how markets adhere to patterns is going to be a big help to you. The really good news here for all of us is not that markets typify fractal geometry, though that is good news, and they do, and it's much more simple than, I know fractal geometry sounds like a mouthful, but it's really not. I'm no mathematician, that's for sure. But the really good news here is that we as individuals are naturally very good at pattern recognition. In fact, it's one of the things we're still better at than a computer, and that is simple pattern recognition. A child can recognize a pattern much quicker than a computer can, because the computer just needs too large of a population example, right? A pattern in the market, on the other hand, very simple to recognize. And while each pattern a market creates is wholly unique, yes, that's true, but it is generally just a slight variance from the previous pattern. And you're looking at it on this chart. It's the same pattern over and over again, just on a smaller scale, generally just a slight variance. That slight variance is really nothing to you and I. We could spot it easily. The kid could spot it too. It's like a game. If you show them what to look for, they'll start to find it pretty quickly. But that slight variance throws off the computer, which only knows what to look for, what's programmed into it. And generally programmers try to be as precise as they can when in fact the market's anything but precise, right? It's like a live wire. But it does hold to patterns, we notice, over time. So this may start to help you understand why it is that trading is kind of difficult, because so many of us rely on computer programs to create the indicators we use. So in a way, from my perspective, the computer's getting in a lot of people's way, and this is why Wall Street doesn't make its money from betting on which way a market's going to go, but on taking the other side of all our trades, i.e. making markets, and from getting paid a transaction cost or the spread, also known as commission, on the futures and the stock side of the business. So you actually do have an edge that you probably don't know you have, in that you're good at pattern recognition to begin with. So scalability is going to be important because the markets are going to repeat itself. And you'll see this, I already showed you that in that stock market chart when we showed you how the U.S. stock market likes 382s. Well, the market's just, it's giving you that 382. And if I could tie that in at the beginning when I said, we want to identify the growth pattern in a market. Well, I could tell you right away, I don't even need to know what the market is, but I can tell you that a market that exhibits 382 retracements, that is, that exhibits relatively shallow retracements, is a market with a healthy growth pattern. So when I see a market that gives me 382s, I know that's a market with a healthy growth pattern. And overall, what is that pattern telling me about the fundamental backdrop? In this case, what would a healthy stock market be telling me about the long-term business cycle? Well, I know this, that a market by definition has to be a reflection of underlying fundamentals. Of course, that's going to include Keynesian inputs also too. So when I see a healthy market, I think to myself, well, maybe it's not such bad news overall. Maybe the bad news, may just be on a day-to-day level, and I don't want to get psyched out from that day-to-day. If I could see the overall business as being a reflection of the pattern on the chart, looks pretty good. So you have to be able to make those distinctions. Likewise, if the pattern can change, right? So I have to stay on top of this, because if I see a market exceed that 382 and perhaps give me a 50% retracement, then that's telling me that the pattern is shifting too. So that's a mouthful here. Let me try to get back on point here. Scalability and repetition, another great quality of market movement is it's repetitive. And here we see it right there, boom, boom, boom. The study to describe this phenomenon is called fractogeometry. Once a growth curve is established, be it positive or, in the case of this market, negative, it tends to be repetitive, as we could see in the Aussie dollar chart. I mean, it's like boom, boom, boom. Another easy way to put that is you're looking to sell rallies in a downtrend, right? Now, let me ask you something. You're looking at, obviously, a negative growth curve, right? You're looking at a negative growth curve where the way to be taking advantage of that would be selling after those bull trend line breaks. After these counter trend rallies, draw a counter trend line, and when it breaks the counter trend line, you're going to go short, right? Well, let me ask you something. Why does this have a negative growth curve? We're looking at what is obviously a negative growth curve. So why is it showing a pattern of lower highs and lower lows? Well, the answer on a trading floor, as I told you guys last week, who cares, right? Who cares? Well, that's really not fair. That's really not true for all of us. We can get away with that on a trading floor because you're on the trading floor. You're not there to analyze. You're just there to execute. But we do care, most of us, and that's just how we're programmed. Most of us want to know why something is occurring because it gives us more confidence when we're demonstrating it to ourselves, and that's how we learn. First, we read things, and we study them, then we see them demonstrate it, and then eventually we start to demonstrate them ourselves, and that's when we start executing, and that's when it gets fun. The growth curve. We're going to find out everyone, different people have different growth curves, or learning curves. So that's when it really gets fun. But, it will give you more confidence if you know why things the way they are. That's really just human nature. Honestly, you don't have to know why it's in a negative growth pattern, but it's human nature to want to know that. So in that regard, we're going to describe why it's in a negative growth curve, because the day-to-day negative news flow is negative. The day-to-day negative news flow is not positive. Well, that's true also. Philip J., very good. He said because it's finding orders as it's auctioning down. That too, yeah, that's essentially a manifestation of it. The reason why it is in a negative growth curve overall, though, is you have negative day-to-day news. And I pretty much look at a 4-hour chart and look at the last couple of weeks trading activity, and I don't have to be following the news too closely, although I do follow it very closely, probably more closely than most people. I'm aware of the trends in individual things like the manufacturing trend in the U.S. is pretty negative. On the other hand, housing is not bad at all. You're seeing that long jab kind of broken, and people have been waiting on the sidelines for a long time. And I see now the fear from a lot of people is not that prices go down any further. The fear is that they start to go up, and people haven't taken advantage of the dip they want. There's still plenty of people that are working with jobs that need a house here. So on the positive side in the U.S., the housing market's not that bad. Now, could it shift negative? Sure, it can. We'll be on top of that if it does. But back to my point being that generally, if you're just learning how to trade, take a look at the 2-week pattern on a 4-hour chart. You're going to have a pretty good idea if the news out there is negative or positive. So it gives you a lot more confidence too in understanding that also that the pattern you see on the chart is a reflection of the fundamentals. So you still have event risk, and that's actually something we teach also. Event risk, risk that your method, your win-loss ratio isn't where it should be, or your risk-reward is out of line. Can't think of the term we call for that. Oh, trade expectancy risk. If you have negative trade expectancy, that's a risk to you too. That's a whole other story. I'm sorry. Staying on point though, but scalability and repetition are a great thing, and as is the knowledge that repetition, that pattern that you're seeing is a reflection of what's going on fundamentally. So again, it comes back to, how can we improve your trading? You want to know that when that occurrence happens where direction shifts in line with the price pattern, right there. This occurrence, which we've highlighted with the red circles, is what we call a change of direction. And it's, a more simple way to say this is we're just looking to sell, following rallies in a downtrend. It's amazing how simple it is when you approach it from that perspective, that you're just looking to sell a rally in a downtrend. And when you could see the pattern on the chart, you don't need the aid of anything for you to see that, oh, that's a lower low. Hey, look, guys, you made a lower low here. Hey, then there's a lower high. Well, hey, we have a lower low and a lower high. What's going to happen? Well, maybe you don't take that trade, but by the time you recognize it here, you see, hey, that's another lower high here. So you're going to be tuned in here, and hopefully you're still tuned in here too. You may not be tuned in here quick enough, but by then you should see the patterns obvious. So you want to be focused on when direction shifts in line with price pattern. And boom, boom, and there's two occurrences in the euro just recent. The last one just 2 weeks ago when you shifted in price, you can see it has gone down from there. And I want to hopefully leave some room here at the end to cover the euro, and we'll see what there is to see right now on it. So that all important point where you have a change of direction, how we define this from a geometric standpoint is a change of direction is equal to a trend line break plus a directional line shift. So you guys should all be familiar with what a trend line break is, right? Now we'll show you real quick what a directional line shift is. We define a directional line shift as the low of the highest closing candle in an uptrend. When price closes below the low of the highest closing candle in an uptrend, then we have a directional line shift. I'm sorry, directional line defined. The directional line itself is the low of the highest closing candle in an uptrend. Okay, if you haven't written these down, go ahead and do that. The low of the highest closing candle in an uptrend. Now I want you to close your eyes, and I want you to imagine an uptrend now. And imagine that uptrend, imagine what? 4 or 5 green candles. An uptrend, the candles have to be green if it's an uptrend, right? So I want you to picture a series of green candles. Now focus on the highest closing candle, not the highest candle. I want you to focus on that highest closing candle. That's a very important point in time because that's when the market was its strongest and it closed at that point. And no other point in that near-term trend that you're focusing on was the market stronger than when it was at that highest closing point. The low of that highest closing candle is going to be an important point for you. I'm going to tell you why. Because at the highest closing point, that's when the market's strongest. If something were to change in that market to force price to close below the low of the highest closing candle, then you have a shift in direction. That's why we call that point a directional line, because if it closes below the low of the highest closing candle, you're going to have a bearish change of direction. Now, coming back to the slide, look at the second point, that the high of the lowest closing candle in a downtrend. Same thing. Close your eyes. Imagine a bunch of red candles, because if you see red candles, you know you're in a downtrend. Now, imagine the lowest closing of those candles. The lowest closing candle in a downtrend, the high of that lowest closing candle, not the lowest candle, the lowest closing candle. The high of that lowest closing candle, significant area, because that's when the market was its weakest, when it closed on that lowest closing candle. If something happens in the market to get price to close above the high of that lowest closing candle, something's changed in the market. We call that change a change of direction. So write these two definitions down. Once you've memorized the definitions and then demonstrated them to yourself in the market, along with showing how to use the trend line, you'll appreciate it. Directional line used. Hey, keep it very simple. If price is closing below the directional line, direction is down. If price is closing above the directional line, direction is up. We had a question there, is this regardless of color? I'm not sure how to answer that. Maybe in the demonstrations that'll come back. But yeah, we do color the directional lines different colors, and I'll show you that. Hopefully we have time to show you that. I want to stay on point. And here's an example of a couple of directional lines. This is the highest closing candle, right? So you mark the low of the highest closing candle. So you mark the low of the highest closing candle and the trend line. So what's the price reversal definition again? That's worth looking at again there. Right here, trend line shift plus a trend line shift plus a directional line shift. So you had the directional line shift because it closed below the low of the highest closing candle here, and it closed below the trend line. That's a reversal in our book. Likewise here, we'll highlight that point for you here. Then highlight it on the bottom, eyes right on the bottom of the chart. That's the low of the highest closing candle. So once you close below both the trend line and that line, that's going to be significant, especially if you have an accompanying momentum shift too. That'll help it too. We use momentum too to actually filter signals, but that is a signal right there. So that change of direction, very important to you. If you want to know more about the directional line and see some really good demonstrations, it's really spelled out well here. You'll have an opportunity to read it a couple of times. Get the book, Mastering Trade Selection and Management. We wrote that from McGraw-Hill a couple of years back. Chapter 3 is a very good chapter, and it'll explain that. Now, before we go to the chart, show you, how to identify that point now, I want you to understand that we're not showing you how to trade. Far from it. That takes a lot of time. What we're doing is showing you tactics that we use to analyze markets, to put everything in context so that we can make trading decisions. A big reason I don't like giving away trading tactics in a webinar like this is I don't know how you're going to use them. I don't know, it's just one little piece of the puzzle. If you plug it in wrong, it's going to get you in trouble. It's like giving you a piece of rope that's just long enough to hang yourself with. I don't want to do that. I don't want you to risk your hard-earned money in the marketplace, please, before you understand the need for a lot of education, even more experience, and you're going to need time to put it all together. So, I think what we show you here is something that can keep you out of trouble, not get you into trouble, right? So please take demo trading, all that good stuff, more seriously before you trade live. Yeah, absolutely, Terry. That's a great question, and let's get right to the 4-hour chart then. Let's look at the S&Ps are up. You guys are probably more interested in currency trading. Let's do that. Here, let me shift the camera for us. Okay, is everyone looking at that Aussie dollar chart here? And this, remember the Aussie dollar chart we just drew for you. Here's the weekly chart, so you can see the pattern on it. Thank you, Philip. Here's the daily chart where I'm going to back it up a day. It was, see that directional line? The directional line is showing you the high, the lowest closing candle. The low, the highest closing candle in the uptrend. So when we go down, we can watch price go down. See, it stays below that line. The line takes on the form of resistance too. What happens right here? You have a bullish change of direction, right? You close below the high, that low, or the highest closing candle. Now you have a shift in direction. So let's take a look at that on a 4-hour chart. When did you? And what's significant about this level too is now we didn't have the high side of that channel line. If you want to draw it, you could draw it though. I mean, here you could have had that channel line, in place ahead of time if you wanted, but we'll take those out because we didn't necessarily know those there. But what is significant about this level before it got there is it's still a lower high, isn't it? That's a big move down, right? But it's still above the previous low. It's above the previous low there also. So it's still exhibiting a bullish pattern from our perspective. If you have higher lows, then that's a bullish pattern. So when you see this change of direction that we had here, that's going to tip you off. Now, absolutely, we use the change of direction on the 4-hour also, and this probably isn't the best example of it because you just did have, well, here's where it changed direction on the 4-hour chart. This was your lowest closing candle right there, and then this is the shift on the 4-hour. So you had a double bottom here, and then you had the shift on the 4-hour. No, Boyke, I am not related to Chuck. I wish I had Chuck's wallet. Especially when I was younger, I wish I had his wallet. I'm a peaceful man, though, Thanks, though. He's referring to Chuck Norris. No relation. Hey, let's take a look at the Euro-US dollar and see how that's looking. Well, before we leave the Aussie, I do want to say that, this market's not looking bad, right? You had that change of direction on the daily. When you go to your weekly, you're still exhibiting a bullish pattern, right? And if you wondered where I had that, if I go back and put the channel line on there, right, I just copy it to the bottom there. Look at that, looking pretty good, huh? And then the daily, you had the change of direction there. So it's not looking too bad. When you go intraday, I was focusing on this market today. It's come down since then. But here is something I like. When you see a purple line on my chart, that's a 50% bottom. So I like this morning that I had this a double bottom on a 50%. So that's something you focus in on a lower time frame chart. We have a double bottom on a 50% like that. It's all the way down 3-minute chart. When you get that change of direction right there, that's something you stay with there. But and even here you had the bullish pattern, higher low, higher low. So it's easy to focus in on the lower time frame charts. Use when you're confident you have those higher time frame patterns with you. Of course, when you see a shift though, you have to know that and don't get stubborn. And actually, he came all the way down here. So that's your Aussie dollar. It's definitely at interesting levels. Hey, let's take a look at the euro here. I want to see what there is to see here. I've got too many lines going on here. Let me get rid of some of them. I'll have to redo them later. Here, let me get one look at my 15 minutes to see what's going on. Oh, it's right on top of a daily. Oh, it's right on top of the daily directional line too. See that purple line? That's a 50% retracement too. So this is I like this formation right here, right now in the euro on the 15-minute chart. Oh, you didn't have change of direction on the 15-minute yet though. That line right there can't get above. Here, this is an old pattern line. Now, that purple line you see, so you have a confluence of support. The daily directional line is right on top of your purple line. So you have a double bottom, and that would show up on a 60-minute chart. Look pretty good. There it is. Look at that double bottom, baby, on there. So that may be something to look at, too. But I wanted to show you overall, though. Well, here we can see it on a daily. I want you to see the overall pattern here. Here, let me get rid of these lines. The overall pattern to this market. And if you want to trade a market, you got to understand how the overall pattern has played out. And you're not going to expect something to change. Very rarely does things change in markets. I'm telling you, overall, nothing's changed in the European situation for years. And I don't think it's going to change overnight. So you look to markets to behave as they're behaving now, essentially. SLD, which average do I really don't use moving averages much. That's a proprietary indicator you're looking at. If you see generally, I'll take that off the chart. You must be talking about that one. What you want, the reason you want to see the pattern and understand the pattern is understand that patterns don't change. If you have a pattern in place, you're going to hold that pattern. So what's been the pattern in this market? Well, you've had pretty good short covering rallies to sell, right? I mean, just look at the last, look at just this year alone. The last couple of months, the market's had basically what it's doing is it has a downstroke and then it retraces it and runs all the shorts out, right? You get a rally, you get a retracement here, runs all the shorts out, tops out, and then goes back down. And it's just repeating that pattern. Same story here to here down. It'll give you another one. Look at that. In the same area of the chart, the same retracements, tops out a little above, between 50 and 70, it's topping out. So it already did it twice, did it here, and did it here. So why wouldn't we expect that, why wouldn't we keep in mind, well, hey, if that market holds that pattern, the euro, it can rally up towards 130, 131 maybe. So if it gets between 130 and 130.75 or so, hey, that's going to be an area to wake up. So and see if you get a sell setup in line with the overall pattern. So you have to anticipate that this market could just continue to do what it's doing, which is give you nice rallies to sell. I heard you started seeing a lot of press about short squeezes in the euro, a short term, and that was true. It was the market had earned that press. It was showing you short squeezes near term. But if you look at it, that's been the case the last year. The euro, look at this. This is the mother of all short squeezes here. This is why a lot of hedge funds lost money last year because they were all short the euro and they got squeezed out, right? Well, if you look at that pattern, though, it's still putting in this is still a lower high, right? So as long as you're putting in lower highs, then you're good. But yeah, the thing is you have to learn to trade smaller. The problem is really never that price pattern kills you. Size is what kills traders. So you have to learn how to size your positions and how to stay small. I took up a lot of time. Hey, let's take a look at the yen. I've been wanting to look at the yen lately myself. And if you look at, we look for that pattern for the markets to retrace themselves, and you look for buys in that zone there. Somewhere between 50 and 70. Look at the dollar yen. It happens to be in that zone too. Now, you had to change the direction. You're going to get a change of direction today, it looks like, right? But you're still below the trend line, aren't you? So that may be one to watch. You're seeing dollar strength because you're seeing that the Fed is taking QE3 off the table. I mean, it's pretty much off the table. But the reason they say we're going to hang on to the possibility of is if you did have a meltdown in the markets, because nobody knows if the markets, nobody knows when a meltdown is going to come or if it could come. So they have to leave QE3 on the table. But the reason you're seeing dollar strength now overall, and here's your dollar index, by the way, which arguably your primary trend is now up, right? You know how you define a primary trend? Pull up a year's worth of data. It won't be able to hide from you. If you have a year's worth of data, you're not going to be able to hide a primary trend in there. So arguably your primary trend is higher for the dollar index now. So dollar strength could be something that we have to get used to. On the other hand, keep in mind, my guy, the Aussie here, is not in the dollar index. The Australian dollar is not in the dollar index, so you could still see a strong Aussie and in a strong dollar environment. And I think that it's the Aussie's in a pretty interesting position here too. From my perspective, you're in. This is a nice buy zone that I would be looking at right here, and really didn't talk about that. That's something that we teach in the course. Hey, speaking of the course, I better wrap it up. Hey, thank you guys so much for letting us come and speak to you. In exchange for checking us out, I want you to go to our website, IBUniversity, and we'll give you our core concepts 1 and 2 courses for free. IBUniversity.com. Sign up for our core concepts. And with the reason we built our site the way we did, the university, is because number one, it's pretty secure, and number two, it's extremely reliable for video delivery. So our students definitely get to see what's happening next. Our students definitely get to they get the benefit of very reliable service on the video delivery. But the one downside about our current campus is because it's so secure and reliable for video delivery, it's not the most user friendly as far as you guys signing up yourselves and accessing the free stuff. But we're changing all that, so it'll be the best of both worlds. So we apologize if some of you guys tried to sign up for that core concepts and you ran into problems with the because it is a very secure website, but we're going to get that fixed, so don't let that deter you. Go into IBUniversity.com and get that core concepts course, and we'll help you along with that. Do that if you need to. Will there be a meltdown? Oh, I don't know, Philip. I tend to be an optimist, and I just tend to be an optimist. I think you're in a bear market in the euro, and I think the euro probably goes to 119 and then probably 110 from there, and probably par long term. But we don't know the timing of that, and it could just as easily go back up to 140 for all I know. But I don't see that happening though overall. But the euro's in a bear market. Follow the pattern. The pattern will tell you. And Blue Line, do I have a strategy to recognize trading range in markets? Yeah, you got to use your two eyes for that, man. I'm joking around, but it's true. Rely on what you see on the chart and understand that you're probably going to start to see repetition of that. Hey, thanks, Philip. Boyke, from next week, you include other aspects of trading each week. Boyke, from next week, can you include other? No. Again, we have to be very careful what we give away. And I'm not just saying that because we operate in a regulated environment. And thank God we do operate in a regulated environment, because it has to be that way. Believe me, the regulatory agencies out there have helped more people stay out of trouble by taking out people that shouldn't be throwing things around in the public domain. So no, we have to be very careful what we give out. Basically, what you're saying is you want us to take it to the next level for you, right? Now, people pay pretty good money for us to teach them how to trade. So I think we give away a lot for you guys, and I would think just in comparison to what's out there. So, hey, thank you very much. Oh, very good, very good. Hey, and thanks again, and I look forward to doing it again next time. Thanks, Bogdan. Okay, see you guys now. Thanks, Maud. See you next time.